Welcome to the Accumulating Wealth Podcast. I'm Hunter Satterfield.
And I'm Judson Crawford. We're CPAs, wealth advisors, and partners at Kane Waters & Associates, a financial services firm here to help business owners navigate the decisions they face every day.
And we are back with our part two on the markets 4 months into the year. And Judson, I think we have our guest back too, right?
We are once again here with Brad Sanders, and we had so much great stuff to talk about. We divided it into two, and so here is episode 2 of our May 7th market update.
That's right. If you're watching on YouTube, we're wearing the exact same clothes. Let's go. All right. So last episode we teased, we just took a break for 30 seconds and hit play again or record again. We teased the international markets up 30% over the last year, 23% per year over the last 2 years, 22% per year over the last 3 years. Just bananas numbers, Brad. But I think the last year, I mean, that's even a very fascinating one because, I mean, we literally have a war going on in the Middle East. So that is atypical for a market that we see there. So let's break this into two, because I think the comments related to what's going on in the Middle East is going to be important for the bond market as well.
Yeah.
I think the first thing is that 3-year run in the international markets. We've talked at length on here about sector rotation, Judson. We've been talking about it for damn near 3 years on we've got to be international. We've got to be international. To the tune of 20% of our portfolios. And that's proven itself out. But I mean, if you really like, and this just came out with, everything that's going on in the United States right now, where we're trying to get, the best we can onshored for all of the things that we've talked about here domestically. It's a national security risk for us not to be able to create our own chips, to have our own compute, to have our own energy. That same thing. I mean, Xi Jinping's now come out with very similar goals for China, but the reality is we shift away from the globalization that we've been in for the last 25 years, and companies say, this is a national security threat. I have to stand up my own AI to protect my national interest. I mean, that's a lot of what's going on. Is because all of these countries have to stand up their own infrastructure, right?
Yeah, absolutely. And, it gets real fragmented because, Europe gets a lot of its energy from the Middle East, and China gets a lot from elsewhere. And so it's not this like one view of the world anymore. Everybody does things a little different, has different partners for different things. And, I mean, Hunter, you talked about this at the annual meeting. Was that 2 years ago? The multipolar world versus bipolar.
Yeah, we talked about it on this podcast right after that, right?
So, I mean, this is all kind of come up, and then the tariffs really kicked this into high gear. But that's the way the world's shifting, is everybody's going to have to kind of find their place in the world and going to have to be able to do things themselves and not just rely on one or two trading partners to do everything anymore. It's going to create a lot of chaos in the interim as things kind of get fleshed out, which you've already seen over the last 18 months. But it's going to create a lot of opportunity, and there's a lot of that opportunity overseas because just the way the world's structured. Europe in general has been underinvested in globally for the bulk of my career here. They never really recovered after 2008, like most developed markets did, because their banking system basically got blown apart. And so you just haven't had a lot of investment there. And so there are companies over there, which I've mentioned on here before. If you find a very similar company here versus there, you're buying it at a multiples lower in valuation, and they have traditionally better growth metrics because they're not as big. So yeah, all of this is kind of feeding into more of an international, bent in portfolios, and it's going to continue to be that way because as all this AI stuff gets built out, there's going to be areas of the world that are going to be providing one specific thing that we need, and those companies are going to do good. You're seeing a huge run in South Korea, for instance, right now.
I've actually got the numbers on South Korea because it's staggering. Over the last 2 years, y'all, 180% stock market growth, 95% alone in 2025. But yeah, double click on that, Brad.
So one of our managers made this a theme of their portfolio 6 years ago. And they were like, we're investing heavily in South Korea, and it's a large value manager that, and so we were kind of like, okay, because it's one of those. And then once they ran through it, you could kind of see the vision. And then their biggest holding was Samsung for a long time. And I think they made 5 times their money in it. But now it's about 30% of our portfolio with them. It goes up every day. It was up, 2% a day all week, I think. You can look up the ETF ticker. You can kind of track it. But that you've got two things going on there. They have tremendous amount of semiconductors in South Korea, so everybody wants those right now. And they're also democratizing their markets. They've never really allowed outside investment in South Korea. They're going to get added to the MSCI indices. That's just a bunch of capital that immediately goes into that country. These are all things we don't talk about when you talk about domestic markets, because our markets are all mature.
And importantly, these are not speculative themes.
No,
I mean, they're again, it's underinvestment that has been, again, listeners, we've talked at length on here for 25 years. The investment has all been in the United States because of this globalization and this unipolar world we've been in. As we move away from that back to a multipolar world, it's not speculation to say, okay, well, where does the investment need to be? And so, you get South Korea up right there. Taiwan's up 160% over the last 2 years. Turkey, 50%. Brazil, 60%. Peru, 80% in just the last year. So these are companies. They're not speculative countries in any way. They are countries that have high quality infrastructure that they're building up and standing up to be standalone countries, right? And then that's a good investment for a portion of our portfolio.
Yeah, like everybody talks kind of like treats globalization like it's a 4-letter word now. But one of the benefits to that is when you had this global marketplace, all of these countries were able to emulate businesses from the rest of the world and grow these things into real country. South Korea, like 20 years ago, you're like, I'm not putting my money there. I don't even know what I'm buying. You know exactly what Samsung is now. Like, right? That didn't really exist 20 years ago. And so now that this is all unraveling, you're going to have other areas of the world you're going to want to put your capital, not just in the United States. That didn't really exist 25 years ago. You mentioned a couple of emerging markets there. Those things have ripped too. The story in emerging markets is a little different than developed markets, but it's the same thing. These big businesses are there, and the curtain's been thrown back for 20 years, so you can kind of get a handle on what's happening there. It's not this like real speculative thing anymore.
Yeah, I'm reading this book right now about material. It's called Material World. Oh, Madonna.
Yeah, it is Madonna.
You could sing that one too.
I will at the end of the podcast. Stay tuned.
Yeah, Material World, and it's super fascinating. 6 materials that without these, the world would literally go kaput. And there's a chapter in there about just a lot of what you're talking about, and it focuses on TSMC. And this, which is interesting about TSMC, is the guy that started that was actually a TI engineer who wanted to be the TI CEO back in the 80s. They picked somebody else. And so he said, screw you, I'm going back home to Taiwan. And he created TSMC. So to your point, a lot of these folks are a part of a U.S. company, or they've learned from a U.S. company, and they're just standing that up and creating that for their own economy.
Or even are just, we're educated here.
Yeah,
right.
Yeah, exactly. Yeah. So look forward to Material World song here at the end, folks. But that's a lot of the story that we talk about when we talk about the international markets. Now, so I think that's a lot of the growth that we've seen. Now, there is this looming thing going on, and Brad and team spend a ton of time just what's going on over in Iran. And heck, by the time this recording drops, I don't know, maybe it's over. I don't really know, but
nobody knows.
Nobody knows.
Yeah.
Energy's up 35%, and it seems counterintuitive, but Brad, you want to talk a little bit, because gas prices are also over $4 a gallon in Texas now, and we're probably the cheapest in the state. So you want to talk a little bit about not just the near term impacts to the economy and stock market, but maybe some longer term impacts?
Yeah. We're going to have to turn this into a glass half full conversation, I think, now, but you just don't have this kind of disruption. It's going to show up somewhere. It may be short-term volatility, and then we kind of get past it, which is what we've seen so far. It's probably going to linger. It's the number one input into every business and everything in the world is energy. And you can't take the price up 100% and have it not squeeze somewhere. And so where we're seeing some of that right now is in the bond market, which I can get into in a minute. But it's just going to show up. It's going to show up in margin pressure on businesses because their energy costs are higher. It's going to show up in a lot of other ancillary stuff. 20% of the world's fertilizer also comes through the Strait of Hormuz, which we said we weren't going to say on this, but I guess I have to.
Ding.
They make a lot of this stuff they make fertilizer out of. They make right below where a natural gas well sits, and so that's 20% of the world's fertilizer. So you're going to cause food problems like all over the world. You can't just choke all this off and then turn it back on the next day. The damage is already done like the moment you did that. And then I think the thing that people are kind of overlooking is how much damage there's been done to the actual energy infrastructure in all the Gulf states. You know, Iran fired all these missiles off and hit all these refineries and stuff. Those don't get turned back on in a day. Those take months and years to rebuild. And so you're just going to have a new baseline level of oil that's higher than it was this time last year at an absolute minimum.
Well, it's interesting because just a segment ago, we were talking about, these countries that are booming and all of this type of stuff and the globalization of everything. But it's interesting when you kind of go down into, what's going on in the Middle East. Yes, maybe here in America, we have the opportunity to maybe turn up our production, but the rest of the world doesn't.
Right.
Right. And so, it affects all of these different countries that we're talking about in different ways, which is going to affect the global markets.
Yeah, it's a global market. I think people conflate this. It's true that we can be self-sufficient energy-wise in the U.S. Like we could produce enough that we use. It's still a global commodity. So that doesn't mean that the price doesn't skyrocket. It absolutely will. But it does mean that we probably won't run out like some countries will. Europe's got kind of an issue right now. They went into this with like a lot of natural gas reserves. They've tapped all those. They're basically running kind of flat, and they're coming into winter, and prices are astronomical. So you have those kind of problems that are going to manifest itself. So when we say we're self-sufficient, we're energy inefficient, it means we can produce what we use. It does not mean that the price doesn't go up, and that's going to cause profit pressure, margin pressures, consumer spending. Pressure on consumer spending, which is like 2/3 of our GDP. So it's going to show up. Like it has to.
Yeah, I mean, listeners, you can think anecdotally. Like, I mean, Judson, you and I've already had several clients that are like, "Well, that flight's $2,000. It used to be $600." You know,
100%.
so I mean, that is going to create impacts. Even if folks say, "All right, I might still take that flight," other people are not going to.
I'm just going to fly Spirit.
Whoops. Yeah. We're not getting into Spirit today. But yeah, I mean, that is going to create some impact to GDP. And I think this is where it gets hard, right? Because like, I think we can look broadly, and our investment committee talks about this a lot too. We can look broadly at like these big structural shifts, related to, onshoring and lack of globalization or moving away from it. And, the infrastructure that's needed, all the things we've talked about. And we can see broadly where that's going to push us. What we can't necessarily see is the second and third order effects of these more difficult to nail down. Like, what are the second and third order effects of COVID? Nobody could have predicted that. What are the second and third order effects of a limited energy, supply across the world? So I think some of those things are harder, and it'll be interesting to see kind of what does happen to sectors like fertilizer.
Yeah.
I mean, it's very tough to predict.
Third order effect of COVID is going to a multipolar world, right? I mean, you can draw a straight line to people shutting their houses going, I didn't realize all the medications I need to stay alive come from China. Maybe we shouldn't be doing that, and on and on and on. That's what's led us here.
It accelerated what was already happening. You're exactly right.
Yeah.
And just brought that forward. So anyway, long story short, I don't know that we can really predict necessarily what's going to happen with Iran and the implications more broadly, other than it will have impacts on GDP and maybe some of the impacts the positive impacts we talked about in our previous episode, help mitigate some of that. But it'll be interesting to watch. So let's shift a little bit into the fixed income markets. Our average portfolio for, a broadly diversified client, might be 15, 20% in the fixed income markets. And sometimes we don't talk about it because it's kind of boring. We don't really talk about it. But over these longer time, like 6-month timeframes, I think you can start to see some themes. So, and of course, listeners that don't know, Brad, for his career before he came here, this is what he did. And so it's interesting to get his take on what's going on there. So over the last 6-month window, we've talked about all the craziness that's gone on in the broader U.S. stock market. But over the last 6-month window, the Barclays Ag, which is the broad U.S. bond market, is down about 1.4% over the last 6 months. Now, that is not indicative whatsoever. I mean, we've talked at length, listeners, about how active management's super important in the bond indices. I mean, our active managers are up anywhere from 1 to about 6% during that same time frame. One of the things I think thematically, Judson, we can talk about here is that when you actually deal with very structural, difficult things in a bond market, that is when active management proves itself out, right? I mean, you see that down 1.5 index versus up 1 to 6% in active, right? And that the opportunity for these guys to bob and weave around is incredibly important.
Yeah, we've talked about that consistently on this podcast over time, is that, historically, just time and time again, active managers outperform the index, right? And it's why we in the bond market, yeah, and specifically in bond markets, and it's why we have portfolios where even our clients that really want to have, passive investments may have active bond management.
Yeah, I mean, we basically don't have any index bonds here unless a client is just like hell bent on it. We'll go throw them in PLT or ag or something like that. But so I mean, I think, Brad, you want to talk again sort of thematically of why is the bond market broadly, not necessarily our managers, but why is it down 1.5 right now? I mean, we've got some stability in interest rates. They've come down over the last 9 months. What's going on in those markets?
Yeah. So when you invest in fixed income, you're basically taking two kinds of risk. You're taking interest rate risk, or you're taking credit risk, or both. And so what we've seen over the last...
Sorry, let's double click there very quickly. Let's break those down. Okay. Interest rate risk, meaning interest rates can move up or down.
Correct.
And that's a risk,
depending
upon your bet.
I see your bonds go down, right?
Yep.
Interest rates go up, go down, prices go up.
And then credit risk is whatever bonds you buy, that company goes out of business.
Or it can be trading lower because they're stressed, like we've seen with some SaaS companies right now.
Yeah.
So that's what you call spread risk or interest rate risk. So you've had risk arise on both fronts. You've had upward pressure on the 10-year Treasury. That's a lot to do with debt dynamics, geopolitics, and the Fed being reticent to cut because we still have kind of lingering inflation. And then what's really caused the bond market to be down post-Iran is whenever you have a big geopolitical event like this, you're going to have spreads widen. So that means if I was loaning money to a triple B company 3 months ago and the 10-year Treasury is at 4.25%, they may be paying me 5.5%. And I might be happy with that because the market seems normal and there's no conflicts going on and everybody's just rocking and rolling. You shut the Strait of Hormuz, I may want to charge you 6.5% now to loan me my money, or I'll just go put it in a Treasury because I don't really feel good about that. And that's what you've seen is like spreads were at pre-financial crisis tights, meaning that companies in aggregate were paying you the least amount of excess risk premium than they had been for the past 20, 25 years. So there was nowhere to go for that to be but widen. And then you get a global conflict like this, and bond investors are like, you're going to have to pay me a little bit more. And so that's what you've seen. So you've had both of those things happening.
And for these companies, like on a granular level, that means they're paying a higher credit risk premium on their interest rate, and they're paying higher cost for the goods that they need.
And so it's kind of a snowball. And so the longer this goes, the more spreads probably widen a little bit. Doesn't mean you don't get your money back. Bonds, if the company doesn't go broke, you're going to get repaid, but it just means it can mute overall total returns in the short period of time. And so that's just where we are right now. What we've seen our active managers doing prior to Iran and why we've outperformed is, let's just talk about the credit side. When spreads are tight, an active manager will go, okay, this company's a triple B rated credit and it's paying me 6%. This company's a double A rated credit and it's paying 5.9. Why would I own a triple B when I can get a double A paying me almost the exact same thing? I'm just going to move up in credit quality. So we've seen our portfolios naturally, because the curve's been so flat, our credit quality has improved. Why is that important? Well, when you have this Iran conflict, spreads on double A's and single A rated paper don't widen out as much as triple B or even high yield. So our losses have been mitigated by our active managers, and that's just one small thing they do. You do not get that in the index. They just stuff you in whatever the issuance is that year. If it was 30% software companies, you're going to get 30% exposure to software and that year's paper in the index, and that's what you're exposed to there. And so these active managers pay for themselves. I have the view that every investor should be in an active bond fund. We even have some models we've set up now where if you've been passive, you can keep your equity stuff passive, but use the active slice. All it's going to do is increase your compounding over time. And that's net after you've paid the manager. So you don't hyper focus on what you're paying. If you're paying 40 basis points to that manager, they've outperformed by 1% per year for the last 5 years. You've more than paid for that 45 basis. That's after you've paid them, right?
Yeah, I mean, I think the easy way to think about it, listeners, is for 20 years you've had artificially low interest rates. So the gap between what an index and an active are going to do in the bond market is very, very narrow. It's still there, but it's very narrow. When you get these big potential swings in both of these things that Brad has talked about, both the interest rate risk and the credit risk, now you start to see this gapping occur. And it's just going to persist. I mean, there's just no way for it not to, because we don't know the inflation risk that we're dealing with. And remember that in an artificially low interest rate environment, you can have that when inflation is suppressed because you're globalizing everything. When inflation is not suppressed anymore, for all the reasons we've talked about in this episode and the previous one, interest rates just have to remain higher. And so in that world, you're just going to deal with these difficulties. And then you layer on what's going on internationally, and you just get a really, really difficult market. It doesn't mean you can't make money there. It just means you have to be much more nimble in how you approach it.
Yeah, and the bulk of my career here, interest rates were zero until very recently, the last couple of years. I think it's important for listeners to understand we are not going back to 0% interest rates.
For a very long time.
Something tremendously bad would have to. We do not want to be there. Let's just put it that way. It would be the result of something pretty bad. And that's because inflation, to Hunter's point, is higher. There's very little we can predict right now. We said on here, we don't know what's going to happen like 100 times. One thing I will tell you is that inflation is going to be higher. You cannot have the price of oil go from 50 to 100 and not have it show up in an inflation number. What does that mean? That means that the Fed, even though we're getting a new Fed chair here in a couple of weeks, and he's more dovish than Powell certainly was, he's going to be reticent to cut. You can't cut interest rates in this kind of an environment with the unknown inflation pressure out there. So those cuts are going to get pushed. Like we think we might get one in December now for 25 bips, and that would be it for the year. But I think investors need to remember 3% is probably the terminal Fed funds rate here. So we're not that far away. That's 3 cuts from now, basically, because you're not going to be able to get it down there with inflation where it is. And certainly inflation's not going to cool enough to where you could get it sub 3 with the energy markets behaving the way they are, and all commodities really. So that's just one thing that I think is a known. And so you can structure your fixed income portfolios very, very clearly around that kind of a thematic thing for the next 5 years.
Well, the beauty is, Judson, thank you, Brad, by the way.
Yeah.
You're the man. Story time with Brad is always fun. The beauty is, Judson, that for our clients that invest with us, all this stuff just gets built in. So you don't have to worry about it. I mean, we want to bring it to you guys because these are the things that we're constantly thinking about, studying, working with Brad and the Tectonic team to figure out what's coming. But again, the beauty is if you're a Kane Waters client and you invest with us, you don't have to worry about it. This stuff is already in your portfolio. So that being said, we are, unless something crazy happens, we're going to definitely do a post Q2 with Brad again. We'll see on the Fed share side if we need to record specifically on that. And then maybe more importantly, Judson, is that Brad said that if you don't involve me in your top 5, bottom 5 ghosts, then we're dead to him.
Well, maybe that's when we need to do it.
Maybe. So that's coming, folks. Top 5, bottom 5 ghosts. So as always, Brad, you rock. Thanks, man.
You bet.
Yeah, and Hunter and I talked about it offline. Today, for one market update, you actually got 2 full episodes because we had so much to talk about. And the announcement I want to make is that we are not going to charge you double for this. So you can pay the same price on Apple or Spotify for listening to both of these. And if you like that type of value we're bringing you, please leave us a review. If you enjoy us, we'd love to hear your thoughts. 5 stars, the best number. Please leave them out there. If you also want to keep up with us, the best way to do that is to subscribe. That way you never have to miss an episode. You can go back and listen to all the others. If you have a question, comment, or suggestion for a future episode, drop us a line at kmwaters.com/wealth. We really do answer these. And if you want to learn more about what we do when we are not recording these episodes, visit kmwaters.com to see how we're helping over 3,500 clients reach their long-term financial goals. And lastly, we are living in a material world, and I am a material girl.